This is Sandeep Anand. So now we are going to continue on the P&L statement in SAN compounding side. We initially saw each factor in P&L statement, like what is revenue, what is profits, what is operating income, and things like that. Now we are going to see the next important concept, which is called the margins. How to analyze margins of the firm with the P&L statement that we have in hand. So gross profits, is the first one, which is basically gross profits is nothing but revenue. You have to take the revenue and subtract cost of goods and services. You get the gross profits, and gross margin is the first margins which we are going to analyze. Gross margin is nothing but the gross profits that you get divided by revenue, and you typically have to assess how the gross margins are doing with respect to the previous last 2 to 3 years. If the gross margins are increasing, it's a good sign of for a healthy business. Next in line is operating income, which is you have to subtract from the gross profits the operational expenses, generally, which is operational expenses includes sales, general and administrative as well. So you get, when you subtract, you get the operating profits or operating income. You divide the operating income to the total revenue, we get the operating margins. And same like gross margins, operating margins has to be compared how the trend is doing over the preceding years, and higher the operating margin, better health for the business. They are doing something innovative in terms of operational efficiencies, bringing in operational efficiencies or improving the total cost control to improve the margins, operating margins. Next is the net profit or profit margin. So net profit is nothing but operating income minus the interest expenses, and also you subtract the taxes, you get the net profit. You divide the net profit with the revenue, we get the total profit margin, net profit margin as it's called. Higher the net profit margin, better again for the businesses. Now typically whatever operational efficiencies you bring in, whatever operational control cost optimization you do and improve the operating margins, they typically tend to flow into the bottom line, which is the net profit. So net profit is also called the bottom line, and typically the profit margin also tend to reflect that improvement in the P&L statement. And let's take the scenario that we observed in Walmart's case. So you have the total revenue as $500 billion, total gross profits at $127 billion. You divide $127 billion with $500 billion, you get a 25% gross margin, which is pretty good for a retail business. Generally retail business have low gross margins. Operating income, again you calculate it as operating margins, which is operating income divided by revenue. Here it is $20 billion by $500 billion, approximately 4% operating margins. And next in line is the net profit, which is profit margins, net income divided by revenue. So you get $10 billion by $500 billion. Here 2% is the total profit margin. So generally retail businesses are very low margin businesses. It's a volume game, and that's why you see very low margins at the profit level. Hope you found this video informative in understanding the margin concepts.